And the minutes from the latest Fed meeting due today, investors will be watching for any clues about the timing and pace of interest rate cuts. Joining us on the markets, Emily Roland, co-chief investment strategist at John Hancock Investment Management, and Jay Woods, chief global strategist at Freedom Capital Markets. Emily, Jay, great to see you both. Jay, you look at the charts, you looked at kind of what happened last year and how we're set up to this year. What did you make of trading yesterday? Was there anything you could divine about small caps, large caps? Is it too early to say what the mood is like starting out 2024?
We're giving the run up going into the new year, and we're pulling back. I mean, the most obvious thing people said was this market was overbought, and it was. And now we have to just see if we can digest those gains, and this was just a normal pullback, which I believe it was, and set our sights to what are the next legs of this bull market that are going to lead. I like a lot of the setups that we're seeing. The S&P 500 getting very close to that all-time high. Ironically, it was on January 3rd, 2022. So it'll be interesting if we can go full roundabout 2 years later. But I really look forward to earnings season and what the financials can set us up with starting next week.
Yeah, you mentioned the legs that will lead to the next lead up. What do you think those might be? What will be the leaders? Obviously, the Magnificent Seven last year, people saying shy away from those, that we're going to get a broadening this year, so look towards small caps. What do you think will be the catalyst or the stocks that will lead, at least in the beginning of the year?
Well, I still think technology is going to lead. Some of those Mag 7 stocks have pulled back, are basing nicely, and are poised to actually go higher. Of the seven, I think Amazon looks the best. It still hasn't made that all-time high, just trading at 52-week highs now, and it has a lot to reverse. As far as the next group of leadership, I look at the financials. I think when J.P. Morgan kicks things off, and I remember, I'm old enough to remember when Alcoa used to kick off earnings seasons, but now it's J.P. Morgan on the 12th. They're trading within $1 of an all-time high. That's great leadership in the financials. It was up 27% last year. I'm watching Bank of America closely, and then Citi. Citi's trading at 45. You know where it traded in May of 2011 when they did a 10-for-1 reverse stock split? 45. The stock has done nothing for years, and all of a sudden, it stopped going down. It broke its near-term downtrend. It's got a lot to reverse, so I think over the long term, Citi may be poised to come back, and I think the conditions are starting to be favorable. You have a Fed tailwind. You have mortgage rates that are dipping, and with people with a recency bias looking to get into the mortgage market. And when you have J.P. Morgan, Goldman Sachs trading near all-time highs, that's good leadership as you go into earnings season. They break out. We could see a nice bunch of the followers follow the leaders.
Yeah, that Mike Mayo call yesterday calling for tripling of Citigroup, that certainly got a lot of people's attention. Emily, last year was interesting that there's such a huge run-up November to December. There's a lot priced in terms of earnings expectations growth for this year. I guess we're looking at analysts expecting about 12% earnings growth. There wasn't a lot of earnings growth behind that run-up last year. Do you think we're going to make that 12% based on what you're seeing right now?
Yeah, the bar is pretty high for earnings coming into this year, which is the opposite of last year. Investors had a lot going for them coming into 2023, which was, sentiment was very depressed. We had earnings estimates essentially flat, and we started the year at 16 and a half times forward earnings on the S&P 500. And now we've sort of got the flip side of that. We've got optimistic sentiment. We've got earnings estimates being penciled in at 12%. And then we've got multiples at about 19 and a half. So I think in order to meet those 12% earnings expectations, it's going to take a lot. And now we have less fiscal support. We have a much higher cost of capital. And we still need to contend with the lag impact of Fed tightening, which I think a lot of investors have certainly been ignoring, especially over the last couple of months, as we've gotten this Fed pivot party, which has caused this massive risk-on rally. So I do think that we should temper expectations into next year. Perhaps we'll see a rotation into parts of the market that have been left behind, which haven't seen that multiple expansion. I think namely like areas like healthcare and utilities could potentially see a bid.
Emily, I wonder what specifically you'd be looking for in identifying those lagged impacts of Fed tightening. Because if you look at market interest rates, they've been in this zone for a while. Corporate credit borrowing, sure, some of that's going to roll over. It's going to be higher cost. But it seems like there's an equilibrium in the labor market right now. I'm curious what we ought to be alert for as we wait for those effects to kick in, if they're going to.
Yeah, Mike, it certainly seems like we've been waiting and waiting and waiting for the lagged impact of Fed tightening. You look at things like leading economic indicators now negative for a year and a half. You look at PMI data, and we're going to get some ISM survey data today. Investors have largely ignored the fact that PMIs have been sub 50, which suggests contraction in economic growth. It's really been all about the macro. It's been all about multiple expansion, but we're watching for signs that we will see some cracks in the labor market. What typically happens is that the cost of capital goes up. We saw record demand because of explosive fiscal spending in the height of the pandemic, and now revenues are coming off those record levels. Costs are going higher. If you're a company that wants to maintain your profit margins, you have to cut costs. And of course, we know that most businesses' biggest cost is labor. So we do expect to see those cracks forming over the course of the year. It doesn't need to be terrible, but the idea here is how are you going to get double-digit growth after we just saw such incredible revenue growth over the last couple of years?
Yeah, and Jay, real quick, just one sign of strength for the overall market would be IPOs. You'd think after the run-up last year, we'd be seeing a lot of them start to line up for the first quarter. We don't really see that yet. How do you see the IPO market shaping out? When could we start to see some big IPOs hit the market?
I think as early as mid-February to March, you're going to start to see the IPO pipeline. People are waiting for conditions to get better. What's better than all-time new highs? This is a pretty good time to go to the market and to exceed the bar from the last 2 years. It won't take too much. The one that I'm interested in, because of the buzz it could create, is Skims. Kim Kardashian has done wonders in the business world, and there's a lot of rumblings that could go public sometime in the first half of the year. And then Shein has already applied. So there are a lot of things to be optimistic for. And given the low bar, I think we can easily top the last 2 years as far as the IPO market goes.